Hi, I'm Sean McCracken here with Neil Shah, of COO and President of Hersha Hospitality Trust. And Neil, it's been a day talking about how things are good but not great. And I just want to get a sense from you, at Hersha, everybody's talking about how the REITs are sitting on the sidelines. For this year, you guys going to be net seller, net buyer? How's the year shaking out, and how do you think it'll shake out by the end of the year?
Yeah, Sean, for us, we work in 6 primary markets, and they're not that unlike the rest of the U.S. Things are not great, but they're not horrible. There's some markets that have a lot of supply, some that have a lot of great new demand to meet it, others that are getting a little soft. But in that environment, we've been keeping pretty busy. We still find that the transaction market is alive and well. So even though hotel performance is in some markets declining, we're finding that hotel values are holding up pretty well. So we sold a large portfolio of hotels in New York City in the first half of this year, and we're working on a handful of other dispositions that we should be able to execute before the end of this year. So we're going to be a net seller in terms of we will have sold probably by the end of the year, probably 10 to 12 hotels. But we have been buying.
Yeah.
We've bought hotels in a handful of markets that we think have still good growth ahead in the next few years. So we've been buying in Washington, D.C. and up in Silicon Valley.
I have to say, it seems like quite the achievement to sell not only a portfolio, but a portfolio in New York City in this environment. That's not what you hear from a lot of people, that either one of those things are the easiest things to do right now.
Yeah, no, you're right. It is tough. And the operating environment in New York is really tough, primarily because of new supply. But what we're finding is, like I mentioned, values are still holding up. And so this transaction that we did in New York, we sold a portfolio of 7 hotels, but we sold it to a international capital player. It was a Chinese firm that looked to a longer term hold. And so they can see beyond this blip of new supply. So it's just, hey, they can be a 5 to 7 year holder, and then New York looks very good. And second, there's other dynamics at play. They want to get more exposure to the U.S. market. They want to get more exposure to currencies outside of the yuan. And so there are some helpful kind of tailwinds on the transaction market that have nothing to do with hotel performance right now.
Well, that segues to something else I want to ask about. I mean, obviously with that, you got interest from foreign capital. Are you getting other nibbles, other contacts from foreign buyers?
We are. I mentioned that the first half we worked on this New York City transaction. The second half we're working on more suburban select service hotels, major markets, kind of right outside of Washington, right outside of Boston, in Northern California, but suburban and select service hotels. And we weren't sure when we went to market whether there would be an international bid or not for that kind of asset. They weren't kind of center of Manhattan kind of hotels. But what we found is that there is, and it's not Asian capital in this case, but we're getting very close to a transaction that has a lot of Middle Eastern capital that is the investor in it.
And that's been underrated lately. I mean, it's active. It's not as newsworthy as the Chinese capital. It's not on bang, but it's still out there.
That's right. And what we're finding is that there's, like in the Chinese investment landscape, there's Anbang doing big trophies. And then there's a lot of new Asian capital that is looking for yield and cash flow. So we've been able to find a mix of that on the Chinese side. In the Middle Eastern capital, similar. You have QIA or Qatar. You have a handful of players there that are focusing on trophies, but then you have a lot of other capital that's forming, and it's still in the early days of formation of this international capital that's just interested in yield and interested in lodging, because you got to remember, real estate overall is having difficult days today, but lodging has some things that other real estate doesn't. It has an inflation protection, it has the ability to raise rates, it has some things going for it.
Okay, so in general, what are your expectations for 2017, specifically with the REIT space that you guys play in?
Yeah, for us, we'll probably continue to do a lot of the same in terms of transactions. We'll continue to recycle capital, sell hotels that have already stabilized. We've already achieved the highest growth that we can from them. We'll recycle, and then we will continue to reinvest in these handful of markets that we think have good growth. as a market, or they have something in the product that we can fix and you can really create some value. But we do expect 2017 to be another tough year. So unfortunately, there isn't a really bright light at the end of the tunnel. But there is a light, and what we find is, you go market by market, we have a handful of markets that will perform a lot better in 17 than they did in 16. But unfortunately, we have a few others that are going to continue to be challenging.
So how has the just Wall Street attitudes about hospitality and about REITs impacted your business? I mean, I'm sure that's had a pretty stark impact on you, just like it has everybody else working in that space.
Yeah. I think there's in the big picture, Wall Street, institutional capital is recognizing lodging as a major asset class moving forward. So big picture, great news.
Yeah.
There's more and more investors investing in lodging. So big picture, really good. And REITs for that matter.
Yeah.
But small picture, kind of shorter term picture, they are very data intensive, and so this is the perfect conference to be at to be talking about it. They're focused on data, and they're focused on short-term data.
Yeah.
And they have a quarterly outlook. And as we're hearing here in the conference, there isn't great news ahead in the coming quarters, and so that makes Wall Street very cautious in our sector. And so since 2000, really until end of 2014, things were pretty good for the sector in the Wall Street side of things. But since 2015, we've seen a really significant leg down. And that's gotten worse in 16.
Yeah, especially in Q1.
In Q1 was really bad. And in Q2, the Brexit scare in June, that was really bad. Right now, we've had a little bit better few weeks, but we're not looking to Wall Street to finance our growth, fortunately. We can recycle capital and finance our growth in other ways, but it's a short-term perspective, and it's very data intensive, and star reports are very much on the minds of Wall Street investors.
So speaking of that more operational side, then, how's your group meetings business been doing so far this year? I know it's been a talk of a lot of people.
It is. I mean, certain markets are improving on the group side. I think as a whole sector, we were expecting it to be a much more robust recovery in 15 and 16, early part of 16 from group. That didn't really come to pass. I mean, it was better than transient, but it still wasn't great. But now as we get in the back half of the year, and I'm going to speak primarily of kind of convention-related group business, and that is picking up pretty significantly. And markets like San Diego have been really strong, and they're going to continue to be strong for the next year or two on the group side. Boston is picking up again. And so there's some bright spots on the group side. Our hotels and our strategy is primarily to really focus on the transient space, but whenever you have group recovery, that compresses a market and allows us transient guys to do even better. But it's been slower than hoped on the group side.
Okay. All right, well, thanks a lot for joining us.
Absolutely.
And for more news on hotels every day, go to hotelnewsnow.com.